The richest man on the planet, Warren Buffett, once said, "The market is a device to transfer money from the impatient to the patient." And who am I to disagree? But I think there is some nuance to this. There is the problem that people that simply just start out with investing tend to focus on assets where currently the general market attention is. Right? There is attention waves. Sometimes people talk about crypto. Sometimes people talk about gold. Sometimes people talk about tech stocks. Whatever currently the flavor of the day is, there's always some kind of story going around, say, in the financial news. And the issue is, wherever currently the attention is, the prices also tend to be high, right? When everybody has, say, NVIDIA stock on their mind, then obviously a lot of demand for NVIDIA stock gets generated, meaning the price tends to be historically at high levels. Now, when attention moves to another asset, that price might also slowly cripple down, right? Because people are looking for the next big thing. So there is some point here, right? The market indeed does transfer wealth from the not so patient people to the more patient people, because the alternative is to simply just hold over the long term and let monetary debasement do its thing, let the company profits do its thing, right? You're simply just investing, you're not speculating. But I think there needs to be some refinement be done here, because there are obviously also impatient people that trade a lot, that still make money in the markets. Not everybody that trades frequently loses money. And this is simply dependent on how big your edge in the market is. Whenever you're trading, you do have some kind of fees that occur, right? You've got gas fees in crypto. You've got the bid-ask spread in the regular financial system. You've also got potential execution fees by the bank or by the broker, whatever it is, right? You always have to pay something. And if your market edge isn't larger than that fee, then the more you trade, the more you're going to lose money, right? So that's a problem. But what I believe is even more accurate is that the market is not a transfer from the impatient to the patient. I think it's more accurate to say that the market is a mechanism to transfer from the skilled to the not so skilled, or from the informed to the not so informed. The effect is even so strong that it's illegal to be too much informed, right? It's illegal to trade based on insider information. If you're part of the management of a company and you trade based on that information that nobody else has, then that's illegal, right? If you profit from your insider knowledge. So obviously even the regulator knows that knowing more than others is an unfair advantage. But I believe there is a gray line here, right? There is a gray area. What is really insider information? There is public information, there is non-public information. This is how the lawmaker makes a distinction. But the issue is that that public information might be processed very differently by different market participants. So you might simply just say, follow the headlines of the news outlets and you take this as your public information, right? You see record numbers by NVIDIA, and that's how you trade, right? This is the public information, this is zero edge. But there's also other kinds of public information that you might be using that the masses are not using, where you still gain an information edge, where you're still 100% legal. So the example that I sometimes give is mergers and acquisitions. So it's 100% illegal to buy, say, a target company that's about to be bought by a larger company, to buy that target company stock beforehand if you're involved in this M&A transaction, right? If you're part of the management or if you're involved in processing that transaction, you're not allowed to buy the target company stock, because that stock would rise and you would make a lot of money with that M&A transaction front-running the actual purchase. So that's bad, that's not allowed. But what about using public information to estimate what could be the next M&A target, right? You could look at what had been prior targets, what companies have been bought before, what kind of potential similar targets are there? Is there potentially some increased communication between those two companies? That might not be 100% public or 100% super easy to find out either, but maybe there are some hints, right? Maybe you see that the management of company A that uses private jets that can be tracked. Maybe those private jets are suddenly flying always to that town where the target company or the potential target company is based. So you've never seen that the big company ever flew to that town. Now you're suddenly seeing a lot of back and forth traveling to that specific town. And lo and behold, there is a lot of activity from that target company over there. So it could simply just be cooperation, but it could also be an M&A transaction. Or let's say another situation that's actually a real-world example. A hedge fund shot up satellites into space and they looked at the oil reserves from space. They looked at the silos of oil and of all kinds of other commodities. They checked out what's the current level of those reserves. And because they had that knowledge from those photos from the satellite, they could predict the price better. They could know what will be the next announcement. They could front run the public knowledge. In other words, they got private knowledge, but it wasn't insider knowledge. So what you want to do is you want to do a lot of investigation to gain your private knowledge that's not insider knowledge, but that's still better than what the general masses is doing. This is, I believe, what happens mainly in any market. So the markets are simply a transfer mechanism from the well-informed, from the well-skilled, from the people that put in a lot of effort. It's a transfer mechanism to those people from the ones that don't know as much. And I believe that that transfer effect is even more pronounced than simply just the patience effect. You simply have to learn enough. If you want to outperform, you have to be more informed than others and you have to put in the effort. And that's why I like crypto so much, right? This is a crypto channel. I like crypto because most of the information is public on the blockchain. It's public, but it's not well studied by most people. So if you simply just look a bit deeper than most people, if you look at what other whales doing, what other people doing that tend to trade well, when you're following all those wallets, when you're following aggregate statistics around something, then you've got way more information than if you had simply just to draw lines on a random chart. You're actually looking at the silos from space via satellites. You're actually looking at the flight paths of company A flying suddenly to this company B. You're looking at all of that information that most people aren't considering, and that in the end gives you an information edge. And that information edge gives you better pricing, gives you fairer pricing, and that information edge then, of course, also translates into alpha, right? So there's different kinds of outperformance. There's outperformance simply due to sheer luck, but there's also real outperformance simply by knowing things better than others. You have to be better informed than others. And I believe no other market has as much data as crypto. No other market can be used that well to achieve an edge over others to generate that alpha. If you want to become part of the few people that are very informed and of the few content winners, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.